Well, hello and a very warm welcome to this Scope webinar, Prospects and Outlook for ESG Covered Bonds. My name is Keith Mullin, and it's my pleasure to be taking you all through the session today. In a second, I'll hand over to Mathias, Pleißner and Karlo Fuchs from Scope Covered Bonds team, who will take you through a short presentation. We are taking questions, so there is a questions function on the platform, so please feel free to type your questions in as we go along, and we'll endeavor to get to them at the end of the session. In terms of the presentation, very quickly, there's clearly been a lot of focus on ESG covered bonds, labeled ESG issuance. So we're going to start with a very short summary of a long history of covered bonds and show that there has been a track record in certainly social issues. We'll talk a bit about the the EU taxonomy, which we've said rather provocatively, is it a blessing or a curse? And then there's a lot of focus now on how does ESG actually affect risk? So what assessments do we look at in the rating process, and what's the evidence? How does ESG actually impact credit risk? What's the issues around asset credit risk analysis and cash flow risk analysis? And then we'll finish with an outlook. So without further ado, I'm going to hand over to Mathias Pleißner, who's going to kick us off with a bit of history. Thank you very much indeed.
Thank you, Keith. And I don't want to bore people with history, especially not on covered bonds, because I guess most of you are well aware of covered bonds and its history. I still believe it's important and quite interesting because covered bonds do have a long-lasting and strong ESG history. So it's actually more about the S and the G. E is just more recently something which is in the focus, but really let's start at the very beginning. And if I'm saying at the very beginning, I mean that we should go back to 1769, and this was actually when Frederick the Great started to regulate Pfandbriefe under public law. So that's governance, right? That's already the G. And he, based on a royal decree, was setting up so-called Landschaften, and those Landschaften legally secured the ownership over a property and allowed the owner to grant covered bonds over this property. And moreover, regulation did also ensure that there will be a public foreclosure should debt payments were not made. And again, I mean, all of this is 250 years ago. This nice idea was very quickly adopted all over Europe, and basically the start of this highly successful debt instrument, which is the covered bonds. And all of this due to the governance introduced once by Frederick. But would you have imagined that the first social covered bond was issued in 1795, so just around 25 years after Frederick invented the Pfandbrief? And this is 226 years ago. And this initiative was following the Great Fire of Copenhagen. And at this time, there was a great need to organize a credit market that was financing the rebuild of large parts of the city. So the proceeds from those covered bonds issued 226 years ago were invested for a social purpose. So here we go with the S and the social covered bond. I already mentioned it took a bit longer until green aspects came into the focus of covered bonds. It was basically Berlin Hyp issuing the first green labeled Pfandbrief back in 2015. And 1 year before, it was Münchner Hypothekenbank that issued a sustainable Pfandbrief with a collateral based on sustainable, ecological, social, and governance data. Since then, green or sustainable covered bonds became more and more relevant. So today, social or green labeled bonds account for around 15% of new issuances. And that's quite a bit. And if you ask me, further growth is given. If you look at the chart I'm just sharing with you, there's a clear trend, a positive trend of green and sustainable benchmark issuances. So that looks like a success story, if you ask me. The next chart I share with you is basically something I just copied from Commerzbank, as you can see by the colors. As of last week, according to this, there were 70 ESG covered bonds outstanding that together were accounting for 42 billion euros, issued from 37 issuers and out of 12 countries, and issued within 6 currencies. And I find this very impressive, given we talk about a trend, the green trend, that actually was starting just 7 years ago. Now that we do have these green and sustainable bonds, it begs for some standardization, harmonization, regulation, and all of that stuff. Am I right, Karlo?
Yeah, indeed, Matthias. It's one of the challenges, and it boils almost down back to the time when really credit ratings weren't that much established, and really the understanding of credit ratings really were not so common. And this is one of the themes that we have on a regular basis. Actually, the ongoing discussion. Actually, what actually backs the label? What is actually green? And when we look on what's happening, there are so many initiatives going on. Just lately here, the EU Green Bond Standard had been established, and there's already quite a fear that there might be too much of a blur, and that's why ESMA is already coming on this as well, because clearly, I think there's clearly the risk also that there is a mis-selling, that people misunderstand actually what is green. So that actually means we need to see actually what can we look at? And I think one of the widely anticipated, but then initiatives was with the EU taxonomy. But having said so, when the final way was then presented, there was a lot of soberness that came in, because clearly it was not what it was expected. Initially, it was quite restrictive. And yes, we had now some alleviations that the pure focus on the highest energy labels has been slimmed down, but it still begs the question that, in ESG, even a taxonomy compliant asset in country A is not the same as in country B. And further, you always need to be lucky that you actually have this information. So I think it comes to no surprise that, when it comes to the E side of things, you might actually in the end be able to get something, because a lot of the countries in Europe have introduced energy efficiency standards for new buildings, and therefore you clearly can use that as a proxy. But clearly approximation already here is nothing that is hard and fast, and that is obviously what, as a rating agency, we're always looking at. So we are always then looking, and I think we have used the very below chart for quite a while. It's from one of the agencies supporting that. It basically just shows actually how's the dispersion of the various energy levels across Europe. So here you see already quite a wide dispersity, and clearly the largest bars are not the green ones, but the red ones. So the ones that are the least energy efficient. So if you actually want to get something with a green label, this means clearly you need to focus on the A and B, and there, even on a country basis, the pool of eligible assets is already limited. And this is clearly one of the aspects that we all need to bear in mind, that it's going to be a Herculean task first to get all those data into the systems of the issuer so that they finally can use it. And further, we need to be aware that they don't mean the same thing. And clearly that's also the same with ratings. Sometimes, one rating agency has another definition of a rating than the other, even though in the end, everybody uses it simultaneously. And therefore, I think in order to make that happen, a lot of industry effort needs to go in. And that's clearly where we're going to see later on, as before for the covered bond themselves, the ECBC and EMF are actually quite supportive on that, and trying to introduce some kind of standardization, some more comparable data collection. And that's really what we need in the rating process, that we have standardization, that we really can compare apples and apples and don't have to fear that at some point in time, the apple that we thought it was is actually a rotten pear. We don't want to have that. So what are we trying to do actually to incorporate ESG information in our rating process? And I think, as Mathias already highlighted, obviously the whole cover bond concept in its very beginning already has had some flavors of ESG, and that's clearly the predominance of the governance factors that are key to any rating that is assigned. Let it be a bank, let it be a corporate, let it be actually also a sovereign, because it's always the willingness and ability of an entity to honor its payments. And clearly this willingness depends on a strong governance structure that you have. So looking actually at the way that we construe the cover bond rating, where do we have ESG factors that play a role, and how do we try to actually embed them? For those that are not too familiar with our rating approach, just a small recap. When we look at our bank rating, and the bank rating methodology was recently updated in January this year, and we actually now have a prominent pillar, the so-called ESG and D factor. And what is this all about? We're actually trying to make more prominent and measurable the impact of sustainability with regard to these factors. And they are clear because, you know, having a strong ESG governance structure, having the ability to look at the various aspects of ESG, setting aside how they are defined, is really key, because regulators, as we mentioned before, they are keen to also help the green market to grow. And how they do that, they're trying to come up with measures. We recently heard about the green asset ratio, and clearly you can debate about that. We are talking about the necessity of a bank to be able to assess their exposure against climate risk, because in the end, you could argue, you know, it's part of the normal credit due diligence, because what you do in the due diligence, you want to see the risk. And clearly, sometimes you already do that implicitly, because you already have actually, when you look at the building that is at the shore, you know, what could be the impact of a flood, and therefore it's already incorporated. However, I think what we all need to learn, things need to be more formalistic in order to actually capture them in the rating process. So we have a lot of hardship in front of us, because most of that actually will come really from going back into the files, digging out the data. And we're going to hear later on how difficult that is actually for the issuers. Just to again, where are the ESG factors in our cover bond rating? In the bank rating, the ESG assessment already speaks to an adjustment of the rating. Clearly, at this point in time, it's not yet material, this isolated factor. But obviously, if you don't do it adequately, then clearly you could have an issue on your asset credit quality. When we look further then on the rating construct of a cover bond, we always have these fundamental support factors. And when we look at the fundamental support factors, then we have clearly governance considerations left and right. And this is what I said. Governance always has been one of the key pillars of the rating analysis. And therefore, in this first pillar that we have, that we do split into the legal framework assessment as well as the further support assessment, there actually the governance aspects clearly play a role. And Mathias highlighted that clearly the governance that is actually stipulated via the law is one of the key factors that is important to actually make sure that you actually can rate a cover bond higher than the bank as a starting point. And further, when we look at the other factors that we have in this part of the analysis, where we speak about the relevance of a cover bond in the market, about stakeholder support, I think this is also some very clear governance assessments that you're doing here. So that's really clearly out there. And in this year's update of our methodology update, we actually introduced another governance factor. You might not be aware, but we have introduced what we call a CPC score. What do we mean with that? Basically, this cover pool complexity score, we try to actually find the balance between the risks that are in a cover pool and the transparency provided. Clearly, most cases, we're actually quite in a benign situation as a rating agency because we have access to information in order to assess the credit quality of a covered bond. But there also could be instances where we rate based on public information. And clearly, when we rate based on public information, we're in the same boat as any other analyst because we need to strike the balance between how do we assess the complexity of this program. What is the impact of rating factors? Typically, we do assess in our rating analysis, in the cover pool rating analysis, the counterparty risk analysis. Do we actually know whether and what swaps are in there? Do we know what are actually the risks they are exposing? Do we know anything about granularity? When you look at a methodology, we've come up with some measures on how to actually classify this balance between complexity and transparency, because clearly we are of the opinion that if we want to provide benefit to the cover pool, we only can do that if and when we also feel very comfortable about the transparency that is provided by an issuer on an ongoing basis. And this basically then means that this G factor actually is one of the pillars that actually allows us to determine how high above what we looked first, the fundamental support factors, we can rate a cover bond. So assuming we now are clear actually what we are generally looking at, we clearly need also to see how we can actually assess the risk. And here it's like to search for the holy grail. I mentioned already the ECBC and their Bauhaus series. I think they have been quite helpful. And we obviously also try to support them. We're members of this initiative as well. And here you see that it's not only at the heart of the issuers, but also academics to see, is there any relationship between what people do perceive? Is it actually really true that having a higher energy efficiency speaks to a lower PD and to a potentially higher recovery, aka lower loss given default? This is really one of the holy grails that we are currently searching for. But to summarize, most of what we have in here, we aren't there. We haven't found it. We're still the Indiana Jones. We're looking around and we're trying to find them. It's quite a hardship. And yes, we see and follow that you can come up with some kind of statistical relationships. Some of them are stronger and weaker, but all of them currently already have to be seen with a pinch of salt, because there's a lot of tying of the data points together that you have to do. And as mentioned, most of those data points are not in the typical systems that the banks have, because it was nothing that you looked at in the underwriting. And actually, coming back here to the EU taxonomy, one of the fun facts that we always try to say is that, yes, of course, you might in the end have, information, what's the energy efficiency, what's the classification, what's the EPC score. But do you really know how much liter waters a flush of your toilet actually consumes? Because it's not only the classification, it's also the do no significant harm that you need to fulfill. And there were also some studies here, or some presentations from the EBA, where some banks actually presented. And here, this was really the nightmare. Even if you were able to come up with then the energy efficiency, getting then adequate and robust information and do not significant harm, that's really the tough case. And the good thing is, it's not only the industry that is looking into that, it's also the academics, and last but not least, of course, also investors and rating agencies, because it's really at the core of what we're trying to do. Can we really include the benefits or drawbacks of not being efficient or being efficient? So that's what we're trying to do on an ongoing basis. And I guess we put those studies as a reference. So clearly, for those that are really into it, you already might have them. If you need the links to them, let us know. We come back to you. And actually, what we're trying to do in real life cases, Matthias, do you actually want to share how we do and what are some preliminary findings that we have from talking with issuers, looking at the data they can provide?
Yes, Karlo, sure. I mean, we for sure would love to do more. But as always, it's about data, and unfortunately, we don't have the full picture, nor do issuers or other market participants have the full picture. Some of the studies we were just listing were quite good in terms of data availability, but also just focused on specific areas, specific countries, legislations, and even credit products. We also wanted to kind of find evidence that there is a certain relationship between credit risk and greenness. But the only source of data we were provided with that may support such an argument basically came from Norway. Here, what we have received is basically the normal kind of line-by-line information on the loans, on the borrower, on the properties, plus some EPC scores or labels, plus some building standards. And we tried kind of combining this with the creditworthiness of the borrowers, which is expressed as a label between A and J, as you can see here on the slide. So we can see on the left-hand side is basically that we tried to compare the share of green buildings within a certain category of creditworthiness per borrower. And if you want so, from what you see on the left-hand side, you can argue that the better the quality of a borrower is, the more green buildings you might have in this group. Or the other way around, the more green buildings you have, the better the quality of the borrower and the lower the credit risk. Unfortunately, that's just what you see. But if you look into the statistics, if we try to calculate the significance of the same, we unfortunately have to admit that what we see here is not significant. So this is because those borrowers with quite low creditworthiness in the class between G and J, here the number is quite limited of borrowers. And so the significance of the whole story basically can't be told. But it's a start, right? If you look then at the very right, at the chart I share with you as well, what we have done here, we not only looked at the default probability, but we also wanted to understand to what extent the LGD might be exposed towards green buildings. So we did the same for the loan to value levels. And again, I mean, if you see at this chart, you could say, there seems to be a relationship between green buildings and the loan to value. So the more green buildings, the lower the loan to value, and accordingly, the lower the expected loss, which is something which sounds quite great. But again, if we look into the statistics, into the data, the significant, unfortunately, the number of observations within the very low loan to value buckets is too low to really draw a conclusion on the significance of this kind of calculation. However, what we want to say with that is basically we are on it. Whenever we do have the respective data, we will for sure test the data in order to assess and understand to what extent there might be a relationship and to what extent we are talking about a correlation or just causality. It's an ongoing process and, well, we're just on it. I think that's the main message here from that slide. We, as a rating agency, however, are not only interested in credit risk. There are other elements for covered bonds which basically describe the quality of a covered bond, and those are refinancing risks and liquidity risks. So something which more comes from the cash flow risk analysis. And here it's quite clear that ESG compliant bonds do attract more investors, and this may provide for a better and higher investor diversity. And this is clearly credit positive per se. Moreover, ESG compliant bonds may even reduce the average refinancing costs. And what we see from market, honestly, is not that appealing. So according to the market, we see that the ESG premium, or let's call it greenium, is rather tiny. So we talk about 2 to 3 basis points compared to non-ESG compliant covered bonds. But I mean, this is as of today with the tight spreads in any case. However, this is also why, again, as of today, the greenium does not materially impact our quantitative analysis. But again, we are watching it. We look into studies, we are doing our own homework, and as soon as we do have the evidence that there is a certain relationship on credit, but also on cash flow risk, we for sure will implement this even further into our analysis of covered bonds. Finally, we've reached the outlook. So I would say generally, we believe that ESG is and will be a success story. So in terms of governance, the covered bond, as explained, has been shaping and improving during the last 250 years. Lately, the EU harmonization is one of the latest governance initiatives that was optimizing this asset class and will for sure increase standardization and transparency even further. However, the track record on the E is not that strong, given the limitations in terms of time and also the focus of the market regarding those environmental aspects. The EU taxonomy is a great start, but for now has some weaknesses, as already explained by Karlo. Let me very quickly again summarize, because I think this is a important topic, right? For instance, I mean, we do still have the lack of fully compliant energy efficient buildings. The A and B labeled properties are relatively rare in most European countries. But it's also not simply about those limitations on highly efficient buildings. It's also about harmonization of the same. So for instance, based on energy consumption, an EPC rating of A in Austria or Norway equates to an EPC rating of D in Portugal or B in Germany. So that may be even a competitive disadvantage for those that score more conservative. Most important, however, is data, right? And it's also important that lenders really start to record EPC data during their origination process. If they don't, that basically disqualify themselves from being able to join the Green Club. The strongest catalyst for improved data, stronger harmonization and standardization would surely be a regulatory recognition on capital requirements. This would for sure force market participants to improve data management and even to potentially allow to manage the bank's capital allocation more efficient. However, this still requires some way to go. And this includes more evidence testing and, of course, more and increased transparency of covered bond issuers and the market in general. For covereds, we think that this does not necessarily require a global or EU-wide legislation, but at least some strong kind of minimum core principles that can be defined by the community and may be supported, for instance, by second-party opinions that are certifying the validity of the promises made. With that, we are done with the presentation, and Keith, I would hand over back to you in case there are any questions.
Good, thank you very much, Mathias, and also obviously to Karlo as well for those comments and those insights. And so for those of you dialed in, please feel free in the next few minutes to type in some questions that we can hope to address. And just one early warning, we are going to be showing a feedback form before the end of the session, and it literally takes 30 seconds to fill in, and we would appreciate if you could fill the feedback form in before you log off. And so actually I've got a question here, a very general question, which I guess maybe I could put to you, Mathias, but Karlo do also pipe up as well. Listening to your comments and the narrative you were expanding there, it doesn't sound like you're too positive on the prospects for ESG covered bonds. Is that a fair assessment?
No, I wouldn't say so. I wouldn't say so. I mean, in general, we do absolutely acknowledge that ESG has positive impacts. And this is not only on the society, but also it helps, of course, to reduce energy consumption, right? And the whole initiatives about ESG, and this includes covered bonds, clearly provides incentives to mitigate the human-made climate change. Though that's a positive for sure, and in principle, all good. On the other hand, as of today, credit effects remain quite moderate. I think that ESG compliant covered bonds remain a great tool to increase investor diversity. This was mentioned already and is a credit positive. And also the greenium, even though it's still tiny, is a credit positive element. However, I mean, for the future, I think still there's a lot of work to do. The overall market has basically to do their homeworks. And then I think, I mean, the overall product is a success story. This is going to work for the future.
Absolutely. Now, in the presentation as well, you also mentioned, in fact, both of you kind of, alerted to some challenges to further growth of this market. If you had to really summarize or just get to the nub of, the challenges to further growth, what would they be?
Yeah, I think that's pretty clear and was mentioning a couple of times. It's all about data, data, and data. As long as we don't have the transparency, which we need to fully understand what we are talking about, then it doesn't work, right? But there might also be other aspects, such as, for instance, the risk that there might be simply too much goodwill, right? That the EU regulators and market participants simply overdo because they're seeking for the great and overarching solution. What I'm not saying that we need another 250 years until we have a well-functioning ESG market and reasonable regulation. But I think it needs some more guidance, right? Or kind of minimum criteria for covered bonds. And it might be good to leave the market to adopt those and just test what's possible, reasonable, and make sense on a moderate or medium time frame.
Actually, if I might add to that, I think one thing also that we should always bear in mind, obviously the taxonomy is basically a kind of gold standard that is put out. When we look back at this one chart that I said I'm using on a regular basis, where you see actually that a majority of covered bonds, not covered bonds, actually of houses, and I'm just flipping to the very chart here, when you see those really red bars that are out there, this is really where a lot of the pollution takes place, where a lot of the efficiency gains could be made. And I think that's why we are actually looking forward to see more of what has also again here Berlin Hüb started for the covered bond world, that is the sustainability linked bonds. So given that here the lifting a building from a EPC D or E to a B is actually brings much more gains for the whole economy than actually lifting a building from energy standard B to A. And last but not least, obviously the cost from B to A or A plus or whatever, they are actually typically much, much higher than actually lifting something from a lower base to a higher base. And that's why we think that the sustainability linked bonds, I think they are really poised to grow, because banks won't be able really to flag all their portfolios into the A or B category so that they have sufficient mass actually to come up with labeled bonds. However, with adequately worded, and hopefully standardization comes in here as well, with adequately worded and comparable sustainability goals, I think this would really help to provide a leapfrog of that market, and also it would be the most efficient. That's why, again, we have a plethora of measures and labels, but in the end, I think investors really should come up with their preferences, what they like. Do they just want to have a tick box where you can say, yeah, we're only financing here A and B? Or do they really want to do something that is beneficial, which is really reducing significantly the energy consumption of a EPC E or D building to something that is much, much better?
Indeed. There's another question, Karlo, perhaps I'll stay with you, about which countries will benefit most from ESG, will see the most growth?
Sure, Germany. We just dropped out of the World Cup, not World Cup, the EM, but I think the Germans have been at the forefront. But unfortunately, in Germany, there's going to be a drawback, and this is whereas in countries like the Nordics, where to a certain extent the data secrecy is not that strong, you can much easier actually get this information. What we hear from a lot of Norwegians that are among the most active is that, if we want to get the data, we just ask our data provider that provides us here with the valuations. And, Norwegians do basically update the valuations typically on a quarterly basis. So we just ask them for another data field, and then actually we get that. Norwegians, there's a lot of transactions going on, so they also have recorded these for quite a while. So Norwegians or other Nordics that really have been there, more proactive in the digitalization of their processes and their valuations, I think they will most benefit. So yes, I'm saying Germany clearly will provide further advances. We're also going to see the Dutch and the French, but still I would see the Nordics on top of the developments.
Absolutely, yes, indeed. I've got a question here, which is actually a very valid question, and it's come up a lot as the ESG labels covered bonds have evolved, which is this: should there be dedicated green covered bond programs? Do you want to have a go at that one?
Yeah, I think it's a blessing and a curse. When we see the current situation, yes, we see green cover bonds, but they are part of a much, much larger pool of covered bonds. And clearly, whereas you can intellectually attach assets to those bonds, latest in the insolvency, you are actually, as typical, pari passu with all the other bondholders. So actually, at this point in time, what you would perceive that you have a benefit because you might have a higher recovery, you won't get that because you're then together with everybody else. So I think there would be benefits for really having dedicated cover bond programs with the respective label, let it E, let it be S, let it be G. But clearly also, I think at this point in time, it's not ideal. The critical mass is not there. And as when the cover bond market was growing across various countries, new issuers then started here with a pool of assets and one bond against that. And clearly, these are quite risky. And, if you want to get the same, AKA green bonds and very high ratings, you actually might be further penalized. You're actually not getting the benefit. You might eventually get a bit of a better funding, but you actually might need to pay for that because of the imbalance on your liability side with higher OC requirements.
No, indeed. Yes, a good point. I've got one more question. So please, for those of you still dialed in, there is time to ask some quick questions. So please feel free to type it into the questions box. The last question I've got here is about ESG issuance and whether covers are the preferred tool.
Okay, let me take that as well, and because I normally speak most anyhow. Okay, I think again here, we already highlighted before that it's quite an effort actually to allocate the respective assets that you need to come up with a green bond. At the same time, the benefit for a green cover bond is something in the 2 to 3 basis point range. So I think the efforts that you need to undertake, they really don't pay off. So I think it might make more sense actually to issue cover bonds potentially with other debt types that the bank has, because still, you would be inclined to originate those bonds, but you might actually get a better benefit, because when you're talking about senior non-pref or even subordinated, I think I seem to recall that we even have seen some AT1s as a green. You actually might get two things. You actually might be able to also get a more stable investor base if you go into those more credit sensitive parts of your balance sheet. We all know that currently everybody sucks off the market anything that has a green flavor, and there's the challenges to come up here with something like a liquid green bond market. Everybody just buys them and holds them. So if you are on the credit sensitive side, eventually you might get a higher benefit if you're issuing green with a non-pref or an equity equivalent that you might actually get here on the covered side. Having said so, and I think I would close with that, covereds are clearly the natural choice, because what's the prime collateral in a cover bond? It's mortgages. And we all know mortgages consume, what is it, depending on the source, 30 to 40% of the energy consumption. And if you can actually improve that and finance it and provide the borrowers with benefits for that, that's good.
Yeah, absolutely. Well, gentlemen, I'm actually out of questions, and I think there are no more there showing from the audience. So unless both of you have anything else to say, we should close the session. I'd like to, if not, would like to thank those of you who dialed in and stayed till the end. I thought we had some very insightful commentary there from Mathias and Karlo. Just a couple of final comments from me. This has been recorded and will be available on YouTube. You can also download the presentation. I gather that I think there's a cloud icon on the right of the screen, which should help you to download that. And as I mentioned before, if you just could very quickly, before you disappear, just click on the feedback form and fill that in for us. That just helps us, create better events for you in the future. On that note, Karlo and Mathias, thank you very much again. Thank you to our audience for dialing in. If you have any further questions, feel free to reach out to any of us, and we will absolutely engage and get back to you. So on that note, thanks so much indeed, and goodbye from us.
Thank you. Goodbye.
Bye-bye.